What's up, everybody? It is Monday, November 29th. I hope everybody had a nice Thanksgiving and a nice weekend. So here we are towards the end of November, getting into the holiday season. All right, the markets bounced back somewhat. Actually, NASDAQ bounced back pretty good today. Almost recovered all of Friday's losses. The Dow bounced back a little bit. It's got further to go. We don't know. I mean, the news on this Omicron, it's still coming out. I think there was one virologist in South Africa, the guy who found this thing, supposedly saying it's not as deadly, the symptoms are not as severe as COVID-19. Anyway, I mean, still going to take time. Let's talk markets. Again, you got to fade panic. Fiscal flows. Don't fade the fiscal flows. You got to go with the flow. Now, fiscal flows just under 30 billion a day. When I'm looking at the 10-day average, that's very strong once again. I think the December 3rd situation is going to be resolved. If you recall, I had been mentioning that, last month. I said we're clear until December 3rd, but it looks like we're going to get another short-term continuing resolution to avoid a government shutdown. And from the looks of the TGA, the Treasury's account, and what is available to sell in terms of securities, it looks like the debt ceiling is going to be a non-issue for a while. In other words, Yellen will be able to run, operationally pretty normal for, it looks like, a fairly extended period. So it looks like smooth waters other than whatever this virus develops into. Right now, there's no anticipated lockdowns. I mean, that would be highly disruptive, and I don't know if we would get an immediate large fiscal response. But don't forget, I mean, the fiscal support right now is significant. I mean, it's big. 30 billion a month, that's the 10-day average. We're looking at probably just under 600 billion. I mean, I've said this so many times. It's down from March 2021 when it was almost $1 trillion in 1 month. But 600 billion is basically about 50% more than the pre-pandemic fiscal support that was going into the economy. And that was enough to keep the stock market. That was all the Trump presidency. Stock market went up. We had corrections. The Fed is using the reverse repo facility to deal with large additions of reserves. Let's talk a little bit about the banking situation, because the data, again, you had strong increases in loans and leases. Real estate loans, wow. I mean, we had the biggest 1 week increase in residential real estate loans in almost 10 years. I mean, it was huge. So don't think the housing market's going to cool down very much, because you still have very low inventory. The months of inventory, I forget, it might be about 4 months or something like that. I mean, the last time housing peaked, you had something like 11 or 12 months of inventory. I mean, we're nowhere near there. So, and lending is booming. And I talked about that. The bank stocks are very interesting because they sold off in this correction. I said last week, or Saturday, Friday, I had a bunch of orders that were just resting below the market, limit orders that I had placed weeks ago, and they all got filled on that pullback, and they're all in the green right now, but we'll see. But banks are still cheap relative to the market, and loans are picking up, and that's really their bread and butter. So that's looking pretty positive. Oil, let's talk about oil. Let's talk about inflation. You still have the market fixated on inflation. You have the market fixated on the Fed making some kind of a tightening move, which I don't pay any attention to the Fed. To me, it's all fiscal. Monetary operations have little long-term effect. I mean, it's like when the central bank does something, it causes a reaction by the zombies. It's like throwing a stone into a still pool of water. You get a ripple effect. Then everything goes back to the real underlying factor, which is the fiscal. If I saw them, wanting to reduce the deficit, that'd be a different story. But that is not happening, and that is not going to happen. And I explain why that is not going to happen. Anyway, crude oil down 16% from the October highs. Gasoline down 25% from the October highs. Heating oil, distillate down 25% from the October highs. Natural gas down, I think, 24% from the October highs. So, I mean, energy was a big component. Now, yeah, we need to see gas prices come down at the pump, and they will. It takes time. The only thing I would say as a cautionary thing, keep your eye on OPEC plus. That's OPEC plus Russia. They might want to do a let's go Brandon thing here. I don't know. But so far, no indication that they're going to make any changes in their output. But we'll see. You got to watch that, because if they do make changes in their output in a bullish way, then oil could easily go right back up again to the highs. But right now, that is, I think, a pretty good respite in the inflation story. But again, the market is fixated on this. Bonds recovered a little bit. And I still think interest rates are coming down just by virtue of the fact that we're going to see continued fiscal support. And if you understand MMT, I mean, all that cash building up in the banking system globally, that just pressures interest rates down. So even if the Fed does raise, it might be a one-shot deal. All right? And then they'll go right back again to, a stable monetary policy, or even cutting rates again. I mean, I just don't see it with all that cash building up. It's supply. Supply of money pushes the overnight rate down. That influences what the Fed does on their policy rate. And so I don't know, man. I just don't see rates going up that much. I think being long treasuries, that's the place to be. That is the contrarian play right now. Anyway, that's it for today, folks. If you like this, please click like and subscribe. Don't forget, go to my website. You got one more day to sign up at the current rate of $500 a month. And on December 1st, it's going to $1,250 a month. It's going to be more geared towards institutions. If you have a problem, talk to me. Maybe I could help you out. All right, everyone. See you tomorrow. Bye.